So this particular video I am going to describe the delta capture trade. So this I will be demonstrating with the help of the Bitcoin's futures and options. And as you know, the same thing you can utilize in other instruments wherever you find this opportunity present. So data capture is a technique in which you capture some amount of intrinsic value of the option and you reinvest that particular intrinsic value plus the time value of that options to buy one extra lot of call option or put option. That is known as your delta capture trade. So before doing the delta capture trade, what are the things you need to understand? First, you need to understand the trend. So any method you follow, if you are following technical studies, you follow that trend analysis of that. If you are following the GAN studies, you can follow the GAN studies for that. If you are following the volatility studies, you can follow that also. So we have a very fantastic tool for the crypto wherein we are doing all kind of analysis in the crypto using GAN angle and volatility. So if I am just calculating it, or I am going for a 10 days period, 5 intradays and other things, calculate. So GAN angle volatility says this, hexagon principle says this, natural constant things also says this. So you can see all these analysis are giving their own views. Fine. So I'll just go to the main topic, which is delta capture trade. So as I said to you, it is one of the fantastic advanced technique. So now imagine a case, we are seeing the Bitcoin, which is currently at 88,445 when I am recording this event. And this particular Bitcoin, whatever the technical things we are utilizing here, you can see here we are having Bitcoin at 88,449. And if there is a super trend, I have put it here, super trend it is telling 89,259. So as per the very easiest analysis, super trend says that if this price crosses 89,259, then the price will go up. And if we fail to hold that, then it has to fall down to 85,588, which is your EMA crossover point, EMA cross point. So this is the two trend points we are getting. Above 89, it is going up. And if we fail to hold that, 85,589 will be the level it has to fall. So based on this, say someone or some traders wants to utilize that and is more convinced towards the downward trajectory, will be thinking to buy that 85,000 put options. This is a general logic. So if I go for the 85,000 put options here, which is quoting at $3,600 as per the Bitcoin's terminology. So if you buy this particular put option at $3,600, what will be your risk? 3,600. So if you are buying this put option at 3,600 USD, and if I am asking you what is your risk here, you will say 3,600 is my loss risk. If the price falls drastically down, I will be making a good money, unlimited profit till the zero, and you can say this is the risk involved is 3,600 for buying one lot of or one quantity, one Bitcoin quantity is 85,000 put option. So one lot is very small. So one lot is 1/100th of that. Sorry, 1,000th of that. So $3.6 one lot if you are buying. So imagine if I say keeping this 3,600 risk, if you devise a policy to buy two lots, So if you buy 2 lots, but your risk will be 3,600. So there, the delta capture technique comes into the focus. So delta capture techniques comes into the focus where instead of one put option, you will be buying two put option. However, your risk will be limited to 3,600 USD. So there only delta capture things will come into picture. So we have found out these trend points and we are more convinced towards the downward trend. So let us construct the strategy, how it will look like and how we will keep that things. So here I'm just deleting the earlier things. Again, also I'll be giving you one more example here. So what I do here, I am just clicking here, I am buying a future. How many lots? One lot. So I'll be going for the limit options and buying at this price. So what I do here, after buying this future, I am going to buy put options, that is 2 lots, as I have told you, that my objective is with the same $3,600, I should be in a position to buy 2 lots. My risk will be same. So what I do, I will be selling one 85,000 call option here. So which is deep in the money currently with respect to the future. So have a look here. So now, if I just go through this particular thing, you can say I am having 3,7510 is the value of the put option and 3450, is the intrinsic value in this call option. So call option which is having 7510 as a premium, it is having 3454 as intrinsic value. So all are having the same expiry. So here 6, 10 5 are 5, 4 4 are 0 and 7 3 is 4. So 4056 as the time value in this call option. And this is the intrinsic value in the call option or the delta it has added into this call option. So through this up move, it has added 3,454 points of the delta. Remaining is the time value. So what happens here if I sell here by buying these 2 lots? How much I am spending? So 36 into 2. So 7,260 rupees I am spending. I have received 7,510. So almost whatever I am spending for put options, entirely I am getting it through that call option sale. I don't want more money should come from the call option sale. So I just want it should be almost equal, little more or little less. So this strategy, once we initiate, what is the objective of this strategy? What it wants to achieve? This strategy will achieve the profit. Suppose from here it has fallen to 85,000. So already intrinsic value of or the delta 3454 is there. That is going to decay from here. You are going to lose the same amount from the future. What will be left out here? The puts will increase and some amount of theta maybe get added to 85. So you will get the profit here. However, if it is going up and not coming down, say it is against you, it is not coming down to 85,000, it is maintaining up and up, so you are going to lose only 3,630. So what you would have lost in by buying one put option, you are losing the same amount here also. But if the trade is favorable to you, then you are going to make twice the profit. You must argue here, why can't I sell some OTM call option instead of ITM? Whenever you will be selling one OTM call option, what happens there? If the price falls, you are not earning the delta. You are earning only theta. That theta will compensate to certain extent. Then after the future will go into the losses. So the same losses, whatever comes in the future may be compensated through the put. You may not make good money. So here, if the price falls, the growth or the delta what is residing inside this ITM call option will come to you as a hand on profit, and the theta is again coming to you as a profit. So the put option also will be a profit. So two wings is going to give you a profit, one wing as a loss. So that will be a game changing situation for you. So that is what is required. So and here what happens if you just look into these payoffs are theoretical models. So normally it doesn't work in this. If you see this payoff graph, what happens here? They're static. That losses never increases here. Static. So it goes to a certain extent and get arrested there. However, if you see about the profitability, profit is in the incremented trend. So profit unlimited, losses will be stagnant, losses will not expand. So it is a L-shape view of these things, or you can say that you are working in more technical words by forming this kind of strategy. You work on the zero standard deviation model. One standard deviation is there, here zero standard deviation. And you will be maintaining by this process, what you maintain. So here delta will be negative 33%, or you can say 30% to 33% of delta neutral is always good for us. So you can say here, if I am just going for the Greek part, I'll definitely see that 33% will be there, see 34% of delta it maintains. So here the delta capture method should be utilized when you are doubly confirmed about the trend, or if you are more confirmed that yes, the trend what is going on now is going to be saturated and not going to move forward, and it is going for a correction, or the correction what is going on, it is going to be saturated and from now onwards it is going to move on. So this can be utilized in any kind of instrument. However, you can use these things only the most volatile instrument. They give better profitability here. However, one thing you have to keep in mind, these two options expiry should be same. Delta capture cannot be utilized with the cross calendar. Delta capture cannot be utilized with different expiry. So there is vertical, horizontal, these spreads you can say diagonal you can utilize, and horizontal spread you can utilize. Vertical spreads you cannot utilize here. So this is what the delta capture technique. We have a fantastic software in the crypto tool. We have made this tool so that you can get the, just by clicking this, it is recommending you the strategy best suitable for that. And this also comes with Gantt study, option study, many things it comes, and many people are testing it. And on this particular crypto things, we are now running a program which is already more than 50 people have joined this program, 1 year program. February we have started a batch, March we have started a batch, and the third batch which is going to be added with few members, and it should be happening on the May 1st. So if you are interested in that, you can enroll. For that, you go to our website, click here, Crypto Lakhpati program details are here, you can enroll. You will learn many things out of that. And the crypto product, what we are saying here, so that product is, you can say this is software only given to those members to utilize. So this product we have not kept in the sales domain to sell that product. Rather, this software will be given to only to the participants of that program. So this is what the strategy I have told you, delta capture trade. And suppose if you are expecting that no, I am not convinced with the downtrend will start after a uptrend, then how you will work out? If you are saying that no, the downtrend why it should come, the uptrend why it will not come? If in case of uptrend, what I should do? So if in case of a uptrend, what I should do? So if that is the things, if you want to test for the uptrend, what you need to do? You need to sell the future. Once you sell the future, say sell, we are doing this sell of the future, we are doing at 88, 490. We need to hunt for a put option, ITM put options, which will cover two lots of OTM call options buy. So left side is call option and right side is put option. If I see here 90,000, no, if I can sell here 5,900, I have to again spend 5,000 points from my point pocket, which I am not. Delta captures theme is not working here. So can I see this 93,000 put option if I sell one lot at 7,700 and odd, I can buy two lots of 93,000 call option. That is two lots I can buy, and that too also at 3,946, which is almost, you can say that 8,000 less by 80 rupees, 7,920 I can get it, and 7,700 I am receiving. So do remember, you should not receive more 3, 4,000, 5,000. You should not pay more also. That should be the idea. So from here, you draw the conclusion, what will be the situation where I should initiate this strategy. So this strategy you should initiate when you are having a great view on the trend, that yes, the trend is going to support you, or after the ripening of the trend, after a 4 to 5 days of rally, you should be contra. After a great fall of 4 to 5 days, you must be contra. So fall happened for 5 days, 6 days, 3 days, 4 days, then I should be contra with this, or I should initiate this strategy, or you should have some technical studies in your background to support you that. So this is how you should initiate this, and this is a fantastic technique, rewards in a great way. What is the key idea behind this? If you are buying one call option, then entire premium is your risk. So X amount if you are paying, this X is your risk. If I say that this X risk with the same risk, you can buy two call options without compromising with the risk, then that will be a fantastic idea. So you are sponsoring the purchase of your options through the sell of another option, and future is standing in between that to help you in the hedging. So that process is known as your delta capture trade. And this is again technically speaking 33% of net delta in the favor of the trade. Again speaking, this is going with the zero standard deviation methodology. So thank you very much. Thank you for your time. Keep viewing this video. If you like, just give a like here, and must share this video with your friend if you think it is a authentic literature. Thank you very much.